and welcome to the Property Wealth Podcast. Today, we've got a really interesting topic. You know, it's something many investors wonder about, cash-out refi versus HELOC for investors.
Yeah, that's right, Sarah. It's such an important decision to make, and it can really impact your investment strategy, especially if you're looking to scale up your portfolio.
Exactly. So we're going to dive into the pros and cons of both options and share some real-world examples to help you figure out which one might be best for you.
And we won't just stop at the basics, either. We'll also chat about when it makes sense to use each option and some of the common pitfalls to avoid. Because, understanding the nuances can really save you a lot of headaches down the line.
Yeah, and I think it's also important to mention how these tools can help you leverage your existing equity to, create more opportunities for yourself in the market?
Absolutely. It's all about making your money work harder for you, and that's what we're here to help you with today.
So grab a cup of coffee, get comfy, and let's get into the nitty-gritty of cash-out refinances and HELOCs.
Sounds good. Let's start by breaking down what exactly a cash-out refi is. Sarah, for people over 40, thinking about cash flow and financial security becomes more critical than ever, especially with retirement timelines approaching.
Absolutely, Mike. It's like the closer you get to retirement, the more you want to ensure that your investments are really working for you, right?
Exactly. And with inflation being a hot topic these days, it's a real concern. You want to make sure your assets are keeping up with or outpacing inflation.
Yeah, a lot of folks don't realize how much inflation can eat away at their purchasing power. I mean, just look at the price of groceries and gas. It's wild.
Right? And that's where real estate can be such a solid hedge against inflation. Property values tend to rise over time, and so can rent. It's like a double whammy for building wealth.
I remember speaking to an investor last month who bought a rental property about 10 years ago. He said his mortgage payment has stayed the same, but his rent has increased significantly. That's a big win, isn't it?
Definitely. And what's more, as people approach retirement, they're often thinking about how to pass wealth down to their families. Real estate can provide that long-term asset that appreciates over time, creating a legacy.
Right. It's not just about the money. It's about security for your family. Imagine being able to hand down a property that's not just worth more, but is also generating income?
Exactly. And that can provide peace of mind. A lot of investors I work with share that emotional side of financial security. It's not just about numbers. It's about feeling safe and comfortable as they age.
Yeah, I think that's a huge point. People want to feel like they're set up for the future, and real estate can play a big part in that. But then you've got these current economic trends too, right?
Absolutely. With interest rates shifting and the market evolving, it can feel overwhelming. But that's where strategies like cash-out refinancing and HELOCs come into play. They offer ways to tap into your home's equity without selling.
And that's key for many investors who might need liquidity for other investments or projects. I mean, having cash on hand can open up so many opportunities.
For sure. I had a client recently who used a cash-out refinance to fund a small multifamily property. He said the extra cash flow from that investment more than covered his monthly mortgage payment on his primary residence.
Wow, that's brilliant. So he's essentially using his equity to create more wealth while still living in his home?
Exactly. And the beauty of it is that he's also taking advantage of lower interest rates on his cash-out refinance, compared to what he'd get with a personal loan or credit card debt.
That's a great point. And it's not just about making money. It's about smart financial management. But, I think there's still some hesitation, right? Some folks worry about debt.
That's true. Debt can feel daunting, especially as we age. But it's all about how you leverage that debt. If you're using it to invest in something that will appreciate and generate income, then it's a different ballgame.
Exactly. It's like using a tool wisely rather than letting it control you. I read about a couple in their 50s who were hesitant about taking on more debt, but they realized that a HELOC could give them the flexibility they needed to invest in a vacation rental.
Right, and that's a perfect example. They were able to tap into their home's equity to invest in something that aligns with their long-term goals. Plus, it's a great way to diversify their income streams.
And think about the emotional aspect, too. They likely felt a lot more secure knowing they had that extra income coming in, especially as they approach retirement.
Exactly, it's that sense of control over their finances. And with the current market shifts, having multiple income sources can provide a buffer against economic uncertainty.
That's so true. You can't predict the future, but you can certainly prepare for it. And real estate has that resilience factor.
Well said. Plus, with the ongoing wealth transfer happening as the baby boomer generation passes assets to the next generation, it's becoming even more important for people over 40 to understand these strategies.
Right. It's not just about accumulating wealth, but also how to manage and preserve it for future generations.
Definitely. And that's where understanding the difference between cash-out refinancing and HELOC can empower investors to make informed decisions.
So as we dive into the core strategies, it's really about aligning those financial tools with your personal goals and timelines, especially as you think about retirement and how to secure your family's future.
Exactly, Sarah. And that's what we'll unpack next. So when we're diving into cash-out refinancing versus a HELOC, it's important to have a solid understanding of what each option really offers, right?
Absolutely, Mike. I mean, they both let you tap into your property's equity, but they do it in different ways, and understanding the nuances can really make or break your investment strategy.
Exactly. With a cash-out refinance, you're essentially replacing your existing mortgage with a new one that's larger, and then you take the difference in cash. So let's say you owe $200,000 on your mortgage, and your home is worth $300,000. You could refinance for, say, $250,000, pay off the old loan, and then you've got $50,000 in cash to use for other investments.
Right, and that's a solid chunk of change. But what about the interest rates?
Good point. The rates tend to be lower on a cash-out refinance compared to a HELOC, which is something to consider. So if you're planning to borrow a significant amount, a cash-out refinance might save you more in the long run.
And with a HELOC, you're looking at a line of credit that's tied to your home's equity. It's a bit more flexible, right? You can draw from it as needed.
Exactly. With a HELOC, you can borrow what you need when you need it, which can be great for managing cash flow. But keep in mind, the interest rates can be variable, meaning they can go up over time.
So that could lead to higher payments down the line, which is something you definitely want to factor in, especially if you're on a fixed income.
For sure. Now let's talk about some practical strategies for investors looking to decide between the two options. A good rule of thumb is to assess your long-term goals. Are you looking to fund a single project, or are you planning on making multiple investments over time?
That's a great question. For someone looking to invest in multiple properties, a HELOC might be more beneficial initially, since it gives you that flexibility to pull funds as opportunities arise.
Right, and you can keep the interest costs down if you're strategic about how and when you draw from it. But if you're looking at a bigger project that requires a lump sum, then a cash-out refi could be the way to go.
Makes sense. And I think it's also important to consider the costs associated with both options, like closing costs on a refinance versus the fees associated with a HELOC.
Definitely. Closing costs on a refinance can be a bit hefty, usually around 2% to 5% of the loan amount. So if you're refinancing for $250,000, you could be looking at $5,000 to $12. $500 just in fees.
Ouch, that adds up. So you'd want to ensure that the investment you're using that cash for could yield a return that outweighs those costs, right?
Exactly. This is where doing your homework and evaluating potential deals is key. A simple checklist can help. For instance, consider the 1% rule. Does the property generate at least 1% of its purchase price in monthly rent?
That's a solid guideline. So if you buy a property for $200,000, you'd want to be seeing at least $2,000 in rent each month.
Right. And then there's the 50% rule to consider. It's a straightforward way to estimate your operating expenses. You'd assume that about 50% of your rental income goes toward expenses, maintenance, property management, taxes, that kind of stuff.
So if you're making $2,000 a month in rent, you'd set aside about $1,000 for expenses?
Exactly. This helps you see what your potential cash flow looks like after expenses, and then you can evaluate if the investment is worth it.
And let's not forget about cap rates, too. That's another important metric, right?
Absolutely. The capitalization rate gives you a snapshot of the potential return on an investment property. It's calculated by taking the net operating income of the property and dividing it by the property's current market value.
So if a property has an NOI of $20,000 and is valued at $200,000, the cap rate would be 10%, right?
Exactly, and a higher cap rate generally means a better potential return, although it can also indicate higher risk.
So it's all about balancing risk with potential reward.
Right, and when you're evaluating a property, you might also want to look at the local market conditions. Understanding how the market is trending can help you make more informed decisions about when to invest or when to pull cash out.
That's a great point. And, working with a good local real estate agent or a market analyst can really help you get that insight.
For sure. They can provide you with comps and market data that really inform your decisions. Now, speaking of decisions, we should transition to some common pitfalls that investors might run into when using these financing options.
Yes, because, avoiding those pitfalls is crucial to maintaining long-term wealth.
Exactly. Understanding the risks, the costs, and having a solid plan can make all the difference in your investing journey.
Let's dive into that next.
Sarah, when it comes to cash-out refinancing and HELOCs, one of the most common pitfalls I see investors make is over-leveraging.
Right. That's a big one. It's tempting when you see your property values rising. You think, I can take out more money, invest it, and grow my wealth even faster.
Exactly. But what happens is they end up stretched too thin. I once worked with an investor who refinanced their property to the max, thinking they could buy 2 more homes. It sounded great on paper, but they didn't account for the market shift.
What happened then?
Well, the market dipped just a bit, and their rental income wasn't enough to cover the higher mortgage payments. They found themselves in a really tight spot, having to sell one of those properties at a loss just to stay afloat.
Ouch, that's tough. It's like they lost sight of the cash flow.
Yeah, exactly. Ignoring cash flow is another mistake I see often. Investors get so caught up in the potential of property appreciation that they overlook whether the property is actually generating income.
Right. It's all about that balance, isn't it?
Absolutely. I had another client who bought a rental property in a trendy neighborhood, thinking it would be a gold mine, but they didn't do their homework on the tenant market. Ended up with long vacancy periods and no cash flow.
That's a lesson learned the hard way. How do you spot those red flags beforehand?
Well, first, really dig into the local rental market. Look at the vacancy rates, the average days on market for rentals. Even talk to other landlords in the area. If you're seeing lots of for rent signs or properties sitting empty, that's a red flag.
And timing the market can be another trap, right?
Definitely. People often think, I'll just wait for the perfect moment. I remember one investor who kept waiting for the market to drop, thinking he'd get a better deal. He ended up missing out on some great opportunities because he was fixated on timing.
Yeah, it's almost like trying to catch lightning in a bottle.
Exactly. It's a gamble. Instead, I always suggest focusing on the fundamentals of the property itself. Is it in a good area? Does it have strong rental demand?
And let's not forget about hidden costs. Those can sneak up on you.
Oh, absolutely. So many investors overlook things like maintenance costs, property taxes, and even HOA fees. I had a client who budgeted for a cash-out refi without really factoring in how much the property management fees would eat into their profits.
That can definitely throw a wrench in your plans.
Right? And then there's the issue of bad tenants. A good tenant can make your investment shine, but a bad one can really drag you down.
I bet you have stories about that too?
Oh, I do. I knew a guy who was so eager to get a tenant in, he skipped the background check. Turned out, the tenant had a history of not paying rent. He learned the hard way when he had to go through the eviction process, which can be costly and time-consuming.
That's a huge risk. So it's important to take your time with tenant screening, huh?
Absolutely. It's worth the effort. I always recommend a thorough screening process. Background checks, credit checks, and even speaking to previous landlords can save you a lot of headaches down the line.
So if someone finds themselves in one of these situations, where they've over-leveraged or chosen the wrong tenant, what can they do?
First, it's about facing the situation head-on. If you're over-leveraged, consider restructuring your debt or selling an underperforming asset to free up some cash.
And for the tenant situation?
Well, if you've got a bad tenant, document everything. Be clear about your lease agreement and stay on top of communication. And if necessary, Don't hesitate to start the eviction process if they're not meeting their obligations.
That sounds tough, but sometimes it's necessary, right?
Definitely. And always learn from your experiences. Whether it's a mistake with financing, cash flow, or tenant management, each situation can provide valuable lessons for the future.
So really, it's about being proactive and educated.
Exactly. By understanding the market, being diligent in your research, and staying on top of your finances, you can avoid many of these pitfalls.
And if you do face challenges, there are always ways to recover and improve your strategy.
Absolutely. And remember, real estate is a long-term game. It's about building wealth over time, not just quick wins.
That's such a comforting perspective. It makes the journey feel more manageable, doesn't it?
For sure. So as we transition to the next steps, think about your current strategy. What's working, what's not, and how can you adjust your approach?
Yeah, and implement those lessons to create a more sustainable investment plan moving forward.
Exactly. It's all about learning, adapting, and growing.
Well, that's a great note to end on as we wrap up this part of our conversation. Let's dive into some actionable next steps for our listeners.
So now that we've dug into the differences between cash-out refinancing and HELOCs, I think it's really important to talk about some practical steps listeners can take today.
Absolutely. It can be overwhelming, but breaking it down into actionable steps makes it so much easier, right?
Exactly. First off, I'd suggest everyone take a good look at their current financial situation. Gather your documents like income statements and credit reports, just to get a clear picture.
That's a great start. And once you have that, it might be helpful to check out some online tools, like Zillow for property values or Rentometer to understand rental prices in your area.
Right. And if you're looking to analyze potential investments, the Bigger Pockets calculator is fantastic. It helps you run the numbers on cash flow, ROI, and more.
Yeah, and Deal Check is another tool that provides a simple way to evaluate deals. I think it even has a mobile app. Super handy when you're out and about.
Definitely. And if you're serious about this, having access to your local MLS can be a game changer. It gives you real-time data on property listings and sales in your area.
That's so true. Plus, I recommend checking out local real estate investment meetups. Networking with other investors can provide insights and opportunities you might not find on your own.
Speaking of networking, podcasts and books can be invaluable resources too. Rich Dad, Poor Dad by Robert Kiyosaki is a classic that really shifts your mindset about money and investing.
Oh, for sure. And if you want something more focused on real estate, the book on rental property investing by Brandon Turner is packed with practical advice.
Also, listening to podcasts like Bigger Pockets Podcast can expose you to real-life stories and strategies from seasoned investors. It's a great way to learn while you're doing other things.
Yeah, I love that idea. And for habits, I'd say start small. Maybe commit to analyzing just one deal a week. It doesn't have to be intense. Just get into the habit of looking at the numbers.
That's a manageable goal. Also, consider setting up a dedicated time each week to review your investment goals. Make it a part of your routine, like a date with yourself.
That's a great suggestion. And while you're at it, join online forums or social media groups focused on real estate investing. Engaging in discussions can spark ideas and keep you motivated.
Absolutely. And don't forget about setting your alerts on property websites. You can get notifications for new listings that fit your criteria, which will help you stay on top of the market.
That's smart. And as you gather more knowledge, it's important to be patient with yourself. Remember, everyone starts somewhere, and it's okay to take small steps.
Yeah, it can feel daunting, but just take it one step at a time and celebrate those small wins, whether it's analyzing a deal or connecting with someone new.
So true. And if you're feeling a bit lost, consider finding a mentor in the industry, someone who can guide you and provide insights based on their experiences.
Great point. Mentorship can really accelerate your learning. Just look for someone you resonate with and don't hesitate to reach out.
Well, with all these tools and resources at your disposal, you're definitely equipped to start moving forward.
Exactly. So those are some practical first steps. Now let's bring this all together. Well, Sarah, it's been quite a deep dive into cash-out refinances and HELOCs today, hasn't it?
Absolutely, Mike. I think it's really important to highlight a few key takeaways for our listeners.
Yeah, let's do that. First off, I'd say understanding the differences between cash-out refinancing and HELOCs is crucial. They each have their own benefits and drawbacks, right?
Exactly. And remember, the cash-out refinance gives you a lump sum, which can be great for big projects, while a HELOC offers more flexibility for smaller, ongoing expenses.
Right, and that leads us to the second point, the cost of borrowing. With a cash-out refinance, you might have a lower interest rate, but you're resetting your mortgage, which can be a big commitment.
And with a HELOC, you're looking at variable rates, which can fluctuate. So it's really about what fits your risk tolerance and financial strategy best.
Thirdly, timing is everything. It's important to evaluate market conditions before deciding which route to take. You want to make sure you're making the most out of your investment.
Definitely. And lastly, I think we should remind everyone that both options can be powerful tools for building wealth, but it's all about how you use them in your investing strategy.
So true, Sarah. Investing in real estate is a journey, and it's all about making informed decisions that align with your goals.
Absolutely. Remember, building wealth through real estate doesn't happen overnight. It takes time, patience, and a solid strategy.
If you found this episode helpful, we'd love for you to like, subscribe, and maybe even drop a comment with your biggest takeaway or any questions you have.
And don't forget to share the podcast with someone over 40 who's looking to dive into real estate investing.
Next time, we'll be diving into how to build credit for bigger loans, which is essential for anyone looking to expand their investment portfolio.
That's right. We can't wait to share that with you.
Thanks for listening, everyone.
Take care, and we'll see you next time.